Do you understand the relationship between Social Security and taxes? Well, if not, we have you covered today in our financial freedom video because we are going to discuss this uncomfortable marriage, so stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Welcome back to our channel. Carson, taxes on Social Security benefits have always been a hot topic for advisors and retirees, and today's lesson will help them to understand the relationship better.
Yeah, Andrew, I definitely sure hope so, because with people living longer and, of course, working longer, being able to reduce taxes on Social Security is going to be important. And so, as you stated today, we're going to talk about this uncomfortable relationship and provide some insight on ways that people can reduce or maybe even eliminate taxes on Social Security. But before we do that, there are always two rules to retirement income that we give you. And Andrew, what are those two rules?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
Okay, so let's go ahead and jump into our lesson today to talk about the relationship between your Social Security benefits and taxes. So when it comes to trying to understand Social Security and taxes, the first thing that everyone must understand is how the thresholds work when it comes to Social Security. The amount of taxes that you will be paying on your Social Security benefits will always depend on your combined income. You may also hear this called provisional income. Now, when we're talking about your provisional income or your combined income, it's going to include everything from your W-2 wages, also tips as well, any net self-employment income, any dividends, interest, capital gains, and even non-taxable interest from municipal bonds will be included in this combined income calculation. Also, 1/2 of your Social Security benefits. So if you take a look at the chart that we have on the screen here, if you are a single person or head of household, that provisional income or combined income, if it's less than $25,000, you will owe zero taxation on your Social Security benefits. But if that combined or provisional income enters $25,000 to the $34,000 threshold, up to 50% of that 1/2 of your Social Security benefits could become taxable. If your income is over $34,000 as a single or head of household individual, up to 85% of the 1/2 of that Social Security benefits that's included in your combined income could become taxable. Now, if you're married, the numbers are different. That threshold begins at $32,000. If you're under $32,000, as you can see on the chart, none of your Social Security benefits will become taxable. But income between $32,000 to $44,000 as a married couple, up to 50% of that 1/2 could become taxable. And as of course you know, anything over $44,000, up to 85% of that 1/2 of your Social Security benefit that's included in that combined income calculation could become taxable. So let's talk about some Social Security planning strategies that you might want to think about in order to avoid the taxation of your Social Security benefits. One of the things that you can really do to help yourself out when it comes to the taxation of your Social Security benefits is to wait until you retire or until you reach your full retirement age or until age 70. And the reason why this could be a really big deal for you is because any Social Security income that you receive before your full retirement age, if you're still working, could be subjected to the Social Security earnings limit and reduce your benefits. Social Security will deduct $1 of your benefit payments for every $2 that you earn above what they call the annual limit. And for 2024, that limit is $22,320. So for every $2 that you earn above this amount, they're going to withhold $1 of your benefit. So if you made over $40,000 in the year, as you can easily do the math on, you literally would not have any Social Security benefits coming to you. Now, with that being said, that is why I would encourage many people, if they're going to still continue to work, to wait to their full retirement age, because at that moment, you will at least get 100% of your benefits, and you can make $100, $200, or $300,000 or more a year and not have any of your Social Security benefits withheld. Now, the added benefit of waiting to age 70, especially if you're still working, is that from your full retirement age to age 70, your Social Security benefits are getting an increase of 8% per year up until age 70, and then it stops. So if your full retirement age is 67, then you can increase your Social Security benefits by 124% if you waited to start them at that age. Now, because I do a lot of planning with my clients around Social Security, I want to add a special note here. For every dollar that you increase your Social Security by, it's one less dollar that you need to take from your other fully taxable accounts. Now, what does this really mean? I say this because when you're talking about the taxation of Social Security, only 85% of one half of that Social Security benefit is taxable. When it comes to your other accounts, if you have to dig in there to support your lifestyle, 100% of that money from those taxable accounts are going to be fully taxable at your ordinary income tax bracket. Now, I want to finish up today's lesson talking about one particular thing that you can really do to help yourself when it comes to your Social Security and taxes in retirement, and that is definitely to consider Roth conversions or Roth IRAs. Here's why it's so important to consider this for your retirement situation to reduce taxes. Roth IRA distributions are not considered in your combined income calculations. It's not even considered. So you could pull $100,000 from your Roth IRA in any given year, and it would have zero effect on pushing your Social Security benefits into a higher taxable threshold. That is why it is so important for you to speak to a certified financial planner who can help you think about these particular strategies and help you maximize your potential in retirement.
All right, Carson. So, what's the moral of this video?
Yeah, the moral of this story is that taxes on Social Security benefits are going to always be frustrating, but there are ways that you can lower and mitigate this particular situation if careful planning is done. And as always, we're going to encourage you to speak to a financial advisor or a tax professional in your area so that you can understand how taxes may affect your Social Security benefits.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.